Nobody really likes paying taxes, but many retirees are unaware of things they can do, strategies they can use to decrease their tax liability. In today's video, we're going to break down 4 strategies that you can use to save taxes and keep more money in your pocket. All right, Alex, strategy number 1 is retirement accounts.
Yeah, company-sponsored plans like 401ks, 403bs, or even 457s can help lower ultimately your tax liability. So pre-tax contributions will reduce the wages that you report on your tax return. So for example, if you're in the 35% tax bracket, in general, every dollar that you put into your 401k plan pre-tax will help lower your taxable income by around 35 cents. There's an important distinction to make here because I get this question asked sometimes, which is, can I contribute to an IRA? And especially as a high wage earner, you're likely to be prohibited from making pre-tax contributions to an IRA. So that strategy of like trying to get more dollars in or reduce your taxable income by contributing to an IRA specifically for high wage earners is usually not a viable option.
That's right. And those pre-tax contributions are taxable later when you go to withdraw them in retirement. So you do really want to look at the big picture and say, what might my tax rates be later on down the road? Some of that we have control over and some of we don't. But you want to, it's not about only saving taxes today. You want to pay the least tax possible over your lifetime.
Yeah, so really the action item here is for folks to add up all of the different income sources that they expect in retirement. So that can include things like Social Security, a pension, maybe some rental income, and then other income sources like maybe a brokerage account or your IRA account, making sure to factor in possibly what your required minimum distributions from your IRA might be in retirement. So add all those things up and see what your taxable income may look like in the future. Again, you're using your best estimates to try and get a gauge on this. Now, if your income is going to be lower in retirement, your taxable income will be lower in retirement, then that's a good way to say, yeah, I think pre-tax contributions to lower my tax rate today make a whole lot of sense. But if you go through this exercise and determine that, my taxable income is actually going to be either the same or potentially higher in retirement, then that might be when you look at Roth contributions instead of pre-tax.
Yeah, at least trying to get a mix of some Roth in there can be really helpful with flexibility later on. All right, strategy number 2 is a health savings account, commonly referred to as an HSA. And this does require being on a high deductible health plan. And just a quick note that you cannot contribute to an HSA if you're already on Medicare.
Yeah. Now, the thing I want to emphasize here is that using a high deductible healthcare plan, which makes you eligible to contribute to an HSA, can be a good plan if you're relatively healthy. So if you have a lot of medical expenses and you've had a lot of medical expenses in your recent past, maybe a high deductible healthcare plan doesn't make a whole lot of sense for you. But if you're healthy, relatively healthy, and are a high wage earner, an HSA can be a really powerful tool. And that's because contributions into an HSA can actually help reduce your federal tax. Growth within the account is tax deferred, and withdrawals that come out of that HSA account, as long as they are used to pay for qualified medical expenses, are tax-free. So there's not really an account like this. Now, there is an added bonus, which is fantastic with an HSA. This does not apply to like a 401k account, by the way. But with an HSA, if you're making HSA contributions via payroll deductions, like through your company, those contributions actually skirt FICA tax, and that would be like Social Security tax and Medicare tax, which add up to 7.65%, which again, for a high wage earner can be a big deal, right? You want to cram as much tax savings in as you can.
All right, and do note that the different states have different rules. Like California does not allow the deductions on HSAs, and that's a big thing to be paying attention to.
Yeah, so I'd say the action item here for folks is to compare how much tax you might save by, let's just say, maxing out your HSA versus paying into a traditional healthcare plan like an HMO or even a PPO. And then the other thing with high deductible healthcare plans is that the premiums are typically lower than a traditional healthcare plan. So for high wage earners, again, the HSA could be a very powerful tool to save a lot in taxes.
Yeah, and those of you that are watching, leave comments down below how you used an HSA to save taxes and how you've been able to use that to manage your healthcare and your retirement savings. All right, strategy number 3, Alex, is just tax efficient investments.
So if all your money is tied up in retirement accounts, either through like a 401k, an IRA, or a Roth, then you really don't have to worry about this. But many people do have non-retirement accounts like a brokerage account. And so these accounts, like brokerage accounts, can create taxes along the way as the account grows and the account pays dividends or capital gains.
We've seen often, more times than once, where a new client will come to us and we always ask for their tax return in order to create an investment plan. Is just a large amount of taxable dividends that are coming to that bottom line, and how we can create tax efficiency in those non-retirement brokerage accounts to save current taxes.
Yeah, and so this is why high income earners need to be looking at things like ETFs, right? So an ETF is a very tax efficient vehicle and a way to invest. The other thing is possibly utilizing state-specific municipal bonds can be another great way to limit and lower your tax liability. So for example, in California, if you're a California resident and you purchase a California municipal bond, the wonderful thing is that the interest earned on that bond is federal and state tax-free. And again, for high income earners, that can be a huge deal, because otherwise you might have to pay either ordinary income or capital gain rates on those dividends. So I'd say the action item here is, if you do have a non-retirement account, look at your statement and see what investments do you actually hold. You do need to look under the hood a little bit, and are they tax efficient? Does your tax rate justify using municipal bonds, especially state-specific municipal bonds, depending upon your situation? So, if you're a high income wage earner and you don't even know that this is a real thing and that you need to be looking at this, give us a call. We'd love to help you out. Take a look, say, hey, you probably should be looking at X, Y, and Z to really be saving your tax bill, not just this year, but potentially in future years as well.
All right, strategy number 4, our final one. It's a big one: charitable contributions.
Yeah, and we'll make this pretty quick. I mean, our tax code is designed to reward generosity, and most people, again, are giving in a very tax efficient way. They're giving cash, and cash is one of the least tax efficient ways to give. So I would say there are 2 main strategies. There's more, but there are 2 main strategies that people should be considering to be giving more tax efficiently. Number 1, gifting appreciated assets. So that can be things like investments, stocks, and bonds that have maybe appreciated in value in a brokerage account. You can actually give those away to charity. So let me give you an example. Let's say you bought XYZ stock for $100 and now it's gone up to $110. What a lot of people might do is they go, well, I want to give money away, so I'll sell the stock and then I'll give the cash to charity. The problem with that is you're likely to pay taxes on that $10 gain. A much more efficient way to do this is you can actually give XYZ stock now worth $110 directly to the charity. And of course, we all know this, charities don't pay taxes. So you cut out the IRS in this transaction, and no taxes are paid as a result. More money goes to charity and more money can hit your bottom line in terms of a tax deduction. And there are multiple tools to accomplish this. You can use things like a DAF, a charitable remainder trust, etc. It just depends upon your specific situation.
Yeah, another great strategy, Alex, is qualified charitable distributions. We've talked about this a lot because we love this strategy. It's basically giving from your IRA directly to charity. You do have to be 70 and a half in order to be able to do this. But if you also have a required minimum distribution, which starts somewhere in your early 70s, depending on the year you were born, then it can match. So in other words, your QCD can go ahead and fulfill that RMD, that required distribution. Great way to give and still accomplish having less taxable income.
Yeah, so the action item here is for people to look at their giving strategy. How do you actually give? Does appreciated asset giving make a whole lot of sense? Are you the age where you might be able to utilize the qualified charitable distribution strategy? Again, you have to be 70 and a half to utilize that, but maybe you can help accomplish your annual required minimum distribution, which is taxable, and maybe you can satisfy that with a QCD, the qualified charitable distribution, which is not taxable. So again, take a look at your giving situation, see how you could make it more tax efficient.
There are more strategies, but certainly these are some simple, straightforward ways to save taxes, put more in your pocket. You do have to look at the big picture. As we talked about before, you don't want that big tax bomb hitting you later in retirement. We previously posted a video on hidden taxes in retirement. We'll go ahead and post that above. Thanks for watching. We previously posted a guide, 5 retirement mistakes to avoid. We'll go ahead and put a link to that in the show notes. You can download it for free. It highlights 5 common and huge mistakes that retirees often make that are avoidable. Thanks for watching. We look forward to seeing you on the next video.